Hi everyone, Joel from Solace Financial with your investment and economic snapshot for November 2025. November was a month of mixed performance and heightened volatility, creating a clear divide between defensive and growth assets. Let's dive into the key highlights. After a sharp mid-month pullback, most major equity indices edged close to flat. Sentiment escalated between strong earnings results and growing caution over the AI-driven optimism that has dominated investment markets this year. A standout performer has been infrastructure, supported by resilient income streams and a sustained demand for utilities. Global equities finished broadly flat, while bond yields diverged as different rate cycles became more pronounced. The US underperformed peers, and gold recovered strongly, edging back towards recent highs of US dollar $4,220. Global equity markets ended flat, with the MSCI World Index up 0.31%. Investors have grown more cautious on the AI thematic, questioning the sustainability of recent earnings and elevated capital expenditure. US bond yields continue to trend lower, driven by expectation of rate cuts over the next 12 months. The S&P ASX All Ordinaries Index fell by 2.51% in November, bringing the year-to-date return to 5.36%. The ASX underperformed global peers, weighed down by stock-specific pressures and a challenging domestic inflation backdrop. Commonwealth Bank retraced sharply from stretched valuations, dragging financials lower. Investor appetite also shifted away from high valuation growth names as optimism around the AI cycle moderated. On a positive side, materials provided support, with lithium stocks rebounding and gold miners benefiting from higher prices. Small caps also softened, with the S&P ASX Small Ordinaries Index down 1.48%. In the US, the S&P 500 edged up 0.25%. Nasdaq Composite fell by 1.51%, and the Russell 2000 gained 0.85%. Volatility was driven around investor reassessment of the AI rally. Despite record earnings from Nvidia, markets are demanding clearer evidence that the massive AI capital expenditure cycle, spanning data centers, chips, robotics, and cloud infrastructure, can deliver sustainable returns. Emerging markets declined 2.38%, with Korea down 8% and Taiwan off by 5%. Gold rebounded strongly, up 5.56%, while oil fell 5.1% on softer demand and rising supply. Bond markets diverged. The US 10-year Treasury fell to 4.02%, pricing in 3 to 4 rate cuts next year. Australia's 10-year rose to 4.53%, reflecting stubborn inflation and a more hawkish RBA stance. Regarding economic developments, two big stories this month. Firstly, the 43-day US government shutdown disrupted key economic data releases. October's job reports and inflation reports were cancelled, increasing uncertainty about Fed policy. Despite this, markets have priced in an 88% chance of a December rate cut. Second, Australia's moved to a monthly CPI framework. Inflation has ticked up to 3.8% in October, driven by housing, electricity and rent. With inflation still above the RBA's 2 to 3% target, rate cuts look unlikely unless the labour market weakens significantly. The RBA has held rates steady in November, noting improving domestic momentum. In other news, payday super is now law, so get ready for this. The ATO has added resources, including a short video for employers and a fact sheet explaining changes to the SuperStream system as a result of the upcoming payday super changes from the 1st of July 2026. The ATO is asking employers to be ready and to ensure that all super contributions arrive in their employees' super fund within 7 business days of the payday. Looking ahead, earnings growth remains a key driver of equity returns. Most major markets enter 2026 with solid momentum, particularly in the US and parts of Asia. The AI thematic adds another layer of support, provided productivity gains and automation deliver multi-year earning tailwinds. Until next time, we'll be watching, and we hope everyone has a great Christmas and wishing you all the best for the new year.